Hello traders, it's Thursday, September the 28th. This is John Kicklider, Chief Strategist for DailyFX.com, back from vacation, and here to give you an FX market wrap-up for the past 24 hours of trading, and we're going to have an outlook for the coming 48 hours. We are in the U.S. holiday, the Thanksgiving holiday, and as we have seen historically, this has led to a significant drop-off in not just U.S. period volatility for the FX markets. It has generally dampened volatility across the global plane in years gone by. So we would expect similar conditions as we go forward. All right, so we have 48 hours of trading left, yet those coming 48 hours may not be as active as many would like. That is something of a concern because we know that there have been a few pairs that have really generated remarkable volatility for a what looks like possible breakout, namely pairs like dollar yen and other yen crosses. But then we also have breakout setups from pairs like euro dollar. All right. These setups are not going to be the most appealing given these conditions, but we'll talk about that today. Now, I said that there are breakout setups on the technical basis, and I think one of the most prominent is going to be the S&P 500. Looking at this index, as you see here, this is actually CFDs, so based on futures, you can see that we have had exceptionally low volatility from this particular index over this so far this week. In fact, if you look at the average true range, the ATR, on this index right now, we are, well, this is including today's date, which is very quiet, could pick up, but it is essentially the lowest we've seen since way back here in February. All right, that is oftentimes, well, alongside the technical wedge that we have here, a sign of breakout or breakdown. I know a lot of people have directional biases implied in those terms. I just look at it as a break from congestion. It doesn't necessarily imply direction, but continuation of the general trend would be more likely given its prominence. Nevertheless, a breakout would seem likely given these conditions, but if you actually look at the backdrop and what we have to expect from the market in general, we have the U.S. markets closed on Thursday, all right, for the Thanksgiving holiday, and they are going to close early on Friday due to the holiday as well. All right. Historically, we know this to be something that really tapers activity. So what I did was I looked at the S&P 500's general activity level, or in this case, the daily range before and after the Thanksgiving holiday, the actual holiday on Thursday, because obviously the index is not open on Thursday. And as you can see, typically we have greater activity on the day before, the Wednesday before the Thanksgiving holiday, and a significant drop-off in activity through the following day. All right. So given these circumstances, as we can see here, it's not necessarily a big opportunity for a breakout scenario. So looking at the S&P 500, and most of you know I like to use this as a gauge for risk trends, that it might seem like a tempting and ominous breakout, but it's probably not going to be something that we have a very easy time generating a substantial move within the rest of this week. Now, of course, we can get a break, but if we get a break up or down, it's more likely to turn into a false move or a break with no follow-through, at least not until the early portion of next week. There is a lower probability. Obviously, there's always a probability of different scenarios, even as we call them fat tail scenarios, but it would really take a lot of fundamental drive to get this market moving, knowing that we do have the holiday conditions ahead of us. All right. Now, I actually in today's Forex strategy video talked about the conditions that we should expect from all the different pairs, from the core majors, euro dollar, pound dollar, dollar yen, and Aussie dollar. So if you want to look at them individually, check out that video. But in the meantime, there are some interesting and different technical patterns that are starting to show themselves in these pairs. Look at the Euro USD. All right, much like the S&P 500, right? It has another short-term wedge, and we can see what happened with the last one. The day after I left for vacation, it actually had a nice break to the downside. All right, well, we have another wedge, and it certainly is in very tight constraint. Yet, expecting a meaningful breakout with follow-through is going to be a little bit more difficult. Now, of course, we can maybe succeed with the low liquidity and amped, which in terms amplifies volatility. So it might be good for a breakout, but not necessarily the follow-through once again. Now, the catalyst for this can actually be Eurozone based. In the upcoming session, we have a known volatility inducer, the German employment figure. Now, when this makes or beats expectations or misses expectations by a significant margin, not just the change figure but the unemployment rate figure itself, we know that this can be quite market moving for the euro. So put against a setup that looks like this, that is in tight constraints, it could be a good market mover for this pair. A short-term breakout, not necessarily follow through. But what about the other euro-based pairs? We have euro-pound safely within a range that I would say spans all the way down to 83, and we'll call at the top of that range 83.75. This might seem like a pretty tight trading band, but for the euro-pound, it's actually not that wide. A couple other euro-based pairs that I think are certainly of greater interest to watch. Euro-Aussie. Now you can see that we've come very close to the 150 level. Now you see a fib here. That's actually a 38.2 fib of a very long-term decline. So this also happens to coincide with the swing high that we had back in August, late August, and we could potentially see follow-through on what was an enormous head and shoulders pattern way back here. This has played out beautifully, but continuation, remember, if you want to see continuation on this, you're buying euro and going short the Australian dollar. Now, I cannot tell you enough that the Australian dollar, looking out a year, 18 months ahead of time, who is going to be at the top of the list for a rate hike? All right, I think the RBNZ certainly has that wrapped up pretty well, but the Australian dollar, the RBA, is more likely to hike than most of the other majors. All right, the Fed, the ECB certainly, the Bank of England, they're not on that list. The RBA is certainly ahead, yet it is vastly underappreciated, vastly undervalued under most circumstances, as you can see here. And this is not just something that we can see assessed in the Euro-Aussie pairing. We can also see this as a consideration for the Aussie in the crosses. All right, I like particularly the yen crosses. Now you can see it deviate from here since the September rally, but I think it's most prominent when you look at the performance of the yen crosses since the Bank of Japan's announcement of its stimulus program back in early April. Now, most of these have been following along dutifully, and they've been doing pretty well. There's one standout, one very prominent standout, and you can see who that is. That is the Aussie yen. All right, the Aussie yen, once, like I just said, the Aussie has one of the best potentials for yen forecasts going forward, and it's certainly underappreciated. And that's because there's a little bit short-term concern that there may be another RBA rate hike, rate cut. I think that's a relatively low probability, though the market's still pricing it in. Even if it does come through, we will have a higher yield on the Aussie than all but the RBNZ's New Zealand set rate. All right. And once you clear that, the return to rate hikes is going to be much easier for the RBA to achieve. So this is nevertheless, through short or medium term, a undervalued currency. And this can certainly, if the yen crosses, for example, continue their rally, I wouldn't necessarily buy into a pound yen, which is leading the pack, and it might seem good for that reason. Certainly the interest rate forecast and the growth forecast improve for the pound, but realistically speaking, it's not undervalued. All right, the Aussie yen would be far greater argument for a follow-through as it's undervalued. All right, so it doesn't have the prettiest technicals. All right, it's not the best short-term look, but when you look at the medium to long-term fundamentals, you can certainly see there is value here that is being underappreciated. Now, since we're talking about the yen crosses, I think the dollar yen certainly has to be added into the interesting aspects of what we're going to be looking for in the final 48 hours of this trading week. We had a very remarkable breakout when we first surpassed this 100 level, which broke this wedge, and it was consolidating just before I left for vacation last week. But as you can see, we've had some pretty remarkable follow through, so much so that we are now at the highest level since late May. So we are on a very strong 6-month high, and this is tracking out exactly as we were discussing the probability or scenario of the last lead up to the Bank of Japan stimulus program. Now, as you recall, this blue box shows us the buildup of the yen crosses ahead of the actual Bank of Japan's stimulus program introduced on April the 4th. All right, the follow-through afterwards was remarkably smaller, yet we aren't at that level. All right, we're not at the time frame for the Bank of Japan to actually follow up on speculation. That's still out in April. The central bank is expected to loosen its monetary policy even further, introduce a QE2, in other words, sometime around the same period in 2014, because we do have a impending tax hike on consumers, and they're expected to help offset the negative impact that might have. So is this a nice wedge break into continuation, something that looks exactly like that scenario from the past? Well, a lot of that has to do with risk trends. All right, that's very important to respect. Now, we've had a remarkable follow-through on Euro Yen, which is just off of multi-year lows or multi-year highs. It's been just about to overtake this previous swing high back here in June 2009. Pound Yen has already cleared its own level, though it has a couple of long-term fibs up here to contend with at about 166.35 and 168. We'll call it flat. But these pairs have already made their move. The dollar yen is still second-guessing its progress. That's interesting because the depreciation of the yen should match nicely with the dollar's appreciation that we've had over this past week, due to the expectations that the Fed is potentially going to move up its taper timetable. We've seen this rising wedge, which is not necessarily that impressive until you start to put it against the rising wedge that you have on risk trends, the S&P 500. These two should move typically in the opposite direction of each other. Obviously, because the US dollar is a safe haven, we wouldn't necessarily seek it out when we're talking about a bid for higher returns. That would send people to high yield, which is the carry trade, or stocks. All right. But indeed, the US dollar has been doing quite well, and that's because of the expectations that were facilitated by the Fed minutes this past week that suggest that there could be as early as a December taper, because the central bank said that they were considering options for how they were going to offset the impact that the taper announcement could have on the market, which is read in such a way that people believe that they're trying to find contingencies and the mechanics of how they're going to conduct this eventual exit. So the dollar has been doing well. The yen crosses, the yen itself is depreciating, or the yen crosses are rising. Yet this has been relatively restrained. It's been bullish, no doubt, but it's still restrained. All right, I think that this is far more a risk player than it is anything else, and you can see here the Nikkei 225 is cutting a very similar pattern to what we've had with the Nikkei 225 here, which is itself a measure of risk, but local risk. We can see this relationship as well in the correlation chart that I like to keep updated. You can see that the Nikkei 225 is in fact even outpacing its dollar-yen counterpart, and interestingly enough, the Aussie yen is starting to lag behind, or is offset by the carry trade. Carry trade's actually dropped, and dropped quite significantly, while Aussie yen has made its move higher. Now, of course, I said the Aussie yen is perhaps the most laggard of the yen crosses. If we look at something like a carry trade index versus an S&P 500 for a risk comparison, there's a vast difference here between these performances. All right, that's very interesting. It says that we are being very selective in what we're looking for, and most likely we are playing, at least on the long side, the stimulus move. We're not playing necessarily undervalued assets. We're not playing a long-term growth outlook. We're not playing even an interest rate forecast where interest rates rise and draw more capital in. We're just playing where the stimulus is greatest. All right. This is quite a concern for the medium to long term, but in the short term, not necessarily a problem. All right, because we can take advantage of it. It's a market reality. As much as we might have a problem with it, it's what the market is offering us. Now, in terms of the dollar yen short to medium term, this looks like it has great potential for follow-through, but if we're talking about a market that doesn't actually want to have a consistent risk drive or is not going to be capable of consistent risk drive, and stimulus expectations are probably going to be relatively steady going into the end of the week, maybe this is not necessarily a currency pair that we should expect a strong trend or even a breakout to new highs. Now, there is some volatility that should be expected in the coming trading day. Friday morning for Japan brings with it some very noteworthy event risk, including the CPI and unemployment rate figures. Those are two very important indicators that will gauge monetary policy decisions. Now, if these are both weak, as they have been in recent months, that's going to be something that further escalates the argument for the central bank to take a move towards more stimulus. All right, move it up more quickly. That would be appreciated by the market, though wouldn't necessarily drive the yen crosses significantly higher, or as I like to compare it to the peak response from the US dollar to taper speculation. It's probably not going to be that high, because when markets are most sensitive is when they're really tapped into risk trends. And as we know, risk trends are probably going to quiet down because of the absence of US-based liquidity. Now, I also want to make a point of the pound dollar. The pound made a really remarkable move, not just here for the cable, but you saw it in the euro. Euro pound with the move to the downside. We definitely saw it with the pound yen to the upside, and perhaps the most impressive of the the pound crosses. This is the pound kiwi. All right. This is actually a very large inverse head and shoulders pattern with the neckline here just around the 2 level, 2 flat. And you can see that we moved right up to that top of this range. All right. And this was spurred by a pound-based move. No doubt this was a response to the UK GDP figures, which came out this past session. Now, this was not necessarily bullish from the headline figure. Remember, this is actually the second reading of this report, so it was just an update. But the inclusion of details showed us that there was a strong consumer base, there was a stronger investment, so fixed investment, and there was also a relatively strong government spending figure, although that wasn't necessarily stronger than was originally expected. So net, it would seem that the UK government is achieving its reduction in government spending, while at the same time the UK economy is really strengthening itself through internal aspects. But without the export figure, which actually knocked off 0.9 percentage points from GDP, all right, this is probably going to be something that cools quite rapidly, because a lot of this has been based upon consumer spending, which doesn't necessarily find strong support through wage growth and employment, and also housing, which is itself, I think, certainly tipping on the side of the bubble assessment. So that was a strong GDP rating for the pound, obviously, through the short term. But follow-through that is not necessarily worth that kind of movement. And we find the pound dollar trying to make a very significant statement on a multi-year wedge breakout without the capability of generating really strong follow-through, whether on a risk basis or a dollar selling basis, because the dollar is obviously going to be lacking for drive over the next 24 hours. So I'm looking at something like this, the pound dollar, and I'm going to be very concerned. This is not I like it technically, but fundamentally, this is not something I'm willing to just trade through the next 24 hours at the very least. I'll reconsider once we get to Friday, but it's really next week where I really will only take this more seriously. The pound Kiwi, on the other hand, something like this, which the interest rate forecasts versus growth forecasts, and certainly given the technical bearings, this could be something of a fade. So I'm going to be watching this very closely. I'm going to be very tempted to short this, though I want to see how this candle specifically evolves going forward. You can also look at pairs like pound Aussie, which made a really dramatic move to 180, or even something like pound CAD. But I think this pound Kiwi really has an interesting look to it. All right. There are a lot more things to consider, but what I want you to think in terms of the short to medium term, and when you separate those two, medium term swings, trend development is looking for pairs that really have a great potential for continuing an existing trend. If I'm looking at something like a S&P 500, if I'm looking at something even like the US dollar, continuing those bull trends is going to be complicated. It's going to be difficult, hard fought, not just because of the immediate concerns like the lack of liquidity through the end of this week, but more so because we're heading into the end of the year. This is the last essentially 5 weeks of trading, nearly 4 weeks, and this is typically a period of lower activity. We're also talking about things like the taper, which are heavily speculated upon. That level of speculation means there's going to be inconsistencies on conviction. All right, so it lacks for trend. It certainly creates volatility, but it does not create the ideal trend circumstances. Something like the yen crosses might be a little bit more interesting. All right, dollar yen, you're going to have a difficult time with this one because of the circumstances with this on the U.S. side. But something like a Kiwi yen, say, or an Aussie yen, or a CAD yen, or certainly like the Euro yen, which multi-year highs, and pound yen, multi-year highs, those are going to be more potentially active medium-term swings because we're talking about Bank of Japan stimulus expectations and risk trends. Risk trends don't have to be the primary driver, though. We know that stimulus expectations are a key catalyst, so we might be able to generate some greater potential from this in that speculation because there's greater consistency here. All right. In the shorter term, you can look for potentially congestion. Look for pairs that are better suited for congestion. Maybe even very short-term breakouts like a Euro USD if there's a proper fundamental catalyst. But more like a pullback in pound dollar towards 162.50, maybe even a little bit further. Maybe finding some congestion in Aussie USD because this has actually driven down for 6 consecutive days. As you can see here, we really don't have 6 days plus of consistent decline or advance very frequently. We've only had essentially 4 other instances of this over the past 3 years. That's a very remarkable consistency, and generally this is a indication of at least a short-term correction, if not a potential reversal as it has been in the past. So this is better for the congestion aspect. All right, we have to play the conditions that we have in front of us and adapt properly. All right, I know there are a lot of medium-term to long-term traders out there, but perhaps this is a better time to wait to add to trades or just wait until you get into new trades. If you cannot adapt to the short term, if you can adapt to the short term, these are better conditions for that. Finding those short-term ranges, finding those very short-term breakouts. Those are the kind of conditions that we're currently faced with. But there are still a lot of options, a lot of opportunities if you know where to look and how to look at it. All right. I'll update you once again tomorrow. I will be in, and hopefully we have some more interesting developments that we can talk about into Friday's trading session. Good luck trading out there, and I'll talk to you once again Friday morning.